Well, good morning to you and welcome to another edition of Expert Alert. I'm your host, Jim Tabor, and this is where we have experts from different types of businesses along the Gulf Coast asking or answering any questions or enlightening you on different things that they deal with. Well, today on the show we have back with us again Carrie and Jennifer Milligan from Strojny. Good to have you back.
Thanks, happy to be here.
Well, thank you very much. Now, we're talking today about something that until I actually saw this, I had no idea what it was. And a lot of you may not either. But exactly what is a RMD, which is required minimum distribution. So what does that have to deal with?
So that required minimum distribution is the government basically requiring you to take money out of your retirement accounts, except for the Roth IRA, okay, by a certain age. That age has been moved. Recently passed legislation earlier this year, the Secure Act was moved to age 72. Okay, so you know your IRAs, you'll have to take traditional rollover IRAs, etc. You're going to have to take a minimum distribution out each year, even if you do not need the money to live on.
I was going to ask, what if I don't need the money?
That unfortunately you have to take it out. So there's options though. That's the nice thing. So first, you know, I'll use my mom as an example. They don't need the money, so what they decided to do is to make memories with the grandkids and take the family on a very nice vacation and use it that way, right?
Wow,
okay.
That's nice.
That's nice. The other thing is you can take that money and reinvest it in an individual account or a joint account with your spouse and just reinvest the money, okay, in a taxable account. A lot of clients we end up seeing, they like to fund educational accounts for their grandchildren, you know, such as 529s, and so to pass on education.
I've often heard
legacy.
about that. People, you know, having money and they say, well, I want to put it into a special fund for my grandchild or something to go towards their education. And,
yes.
and it can only be used for that. They can't go in there and get it and go play with it or something like that.
That's the 529 is totally built for that best vehicle to do that. So and that's a nice way to leave a legacy, you know, as a grandparent. I got my grandchildren through college, or at least helped do that. And that's important for a lot of people, you know, to pass that along. Now, the one thing to keep in mind, though, it's all taxable, right, as that money comes out. Because
sure.
Up until this point, there's no way to get out of the tax of the amount you pulled out of the retirement account. There's only one way that you can do that, though. If you have it sent directly to a charity, you do not touch the money, it goes direct transfer to the charity. And now you don't get the tax deduction, but it's like it never happened. If that makes sense. So basically,
yes, it does.
That's another legacy thing. Charities or things that call to people, they can do that as well and save on the tax.
Now, can they, I don't know, can they take the money out, purchase something to go to a charity and be the same thing? They don't get taxed on it? No, it has to be directly the money.
Direct, yeah, you can't touch it. So it's got to be that. But that's the one unique case you can do that.
So I guess the next question is, you know, should I give my kids, let's say if I have stocks, you know, I've invested in a bunch of stocks. Should I give them the stocks, or should I sell them and give them the cash?
Yes. So this one's pretty complicated because there's a lot of components. Okay. So I would advise people to talk to their financial advisor and tax advisor, because first is you have to figure out, is this stock in a retirement account or a regular taxable individual or joint account? Okay, because it changes the taxation on it. Okay, when you do the sell and take the money out. So that they would have to figure that out. Number two, you got to figure out if that stock is, how that fits into your portfolio and where you're trying to get financially overall. Okay. All right. So once you figure that out, you know, most of the time when we hear this, the stock is in a joint or taxable individual account, you know, so which that means is you're going to get capital gains. Okay, so the client comes and says, should I do this? Okay, well, if you do this, you're going to sell it, then you're going to get capital gains.
Which right now is at a lower rate.
Is at a lower rate. That may change, you know, potentially with the election for next year and things along those lines. But it's one of the lowest rates we've had in history. Okay,
right.
So they can do that. Now, there's another issue that people don't understand. So if I just I can gift them the stock, or I can sell it, then I get the tax hit, then give them the proceeds. Either way, I have to I may have to do a gift tax return, which a lot of people are not.
Is that like if they inherit it?
It's different. So
Okay.
gift tax return is different, and it's different than the income tax return. It's not the same thing. It's a totally different system. But what it does is, if I give you over $15,000 of value, so it could be cash or just fair market value of the asset, then I have to fill out a gift tax return. Now that typically does not give me a tax consequence now. It doesn't affect you at all. Does as far as taxes on that. And I usually do not pay tax on it, but it only brings down my exemption on my estate tax credit, okay, the applicable credit there. Now, the issue is, though, a lot of people may try and do when you give them the stock, you now get their basis. So if the basis in my stock was $100, and when I give it to you, it's worth $500, and you sell it, well, you got that person has a $400 gain. So a lot of times people are asking us, is it better to let them inherit it or to gift it? With inheritance, it's much better because now you get fair market value. It's called stepped up basis. So you get fair market value at the date of the death of the person that you're inheriting the asset from. Okay. So in my made up example of $100 I paid for the stock, gave it to you, it's $500, you know. And if I pass away, the fair market value is $500. Then you turn around and you sell it for $500, you have to report it on your tax return, but there's no tax at all.
Oh.
So it's much better. I know that's a lot. We're kind of throwing a lot at everybody and everything, but basically.
Well, they look at what you're giving them different options to look at too. You know what they can do, and without getting penalized or anything like that. And that's why it's best to come and talk to y'all about it if they're not really sure. You know, what can I do? Right,
and we see it a lot with houses usually too. You know, a lot of times people trying to do it with the houses as well, and getting on the deed before someone dies or whatever.
Yeah.
And they don't realize the gift tax implication. They also don't realize you're going to shoot yourself potentially in the foot with a huge stepped up basis because dad and mom built this house for $50,000 in the 50s, you know, or whatever. So, Jen?
Yeah, so I just say there's a lot to it, and it's a good planning opportunity when you're looking at these. Do I make these transfers during lifetime, or do I wait and let them be part of the estate and the inheritance? A lot to think about there and to consider. I would also say that when you're looking at these type of situations, you want to think about who's going to pay the tax. You know, the person who's giving it away, or the person who's receiving it, because they may be in all different tax brackets and everything too. So there's just a lot to consider but a lot of times when we get these situations and these kind of questions, it's because somebody's looking at Medicaid planning and they're thinking, if I can get everything out of mom and dad's name, we won't have to pay for the nursing home, and that's what they're trying to do. But there's a lot of legal ramifications to that, and a lot of tax ramifications that you want to really make sure you know what you're doing in that circumstance.
And again,
it doesn't always work out the way you think you're going to.
Because you can give them the options of what they can do.
Right.
Even I really hate to go here with this, but with the election situation as they are, it's been 2 days, we still don't know who the president's going to be.
Yep.
Should I stay invested?
Okay, we love questions like this. So there's a lot to consider here. First of all, you know, where we stand, I guess, is it, you know, I don't know, but it looks like from what we read that Biden's probably going to take the presidency and the Republicans will hold the Senate and the Democrats have the House, right? So the markets the last couple of days seem to kind of like it. That as long as the Republicans have the Senate and there's that balance, and that's one of the good things about our government is we have the different branches and we have some checks and balances. So nobody can just take the ball and run with it immediately, right? It's going to take some time. It's going to take some negotiation. It's going to take some cooperation. Markets seem to be okay with that. That's the articles that I've been reading and what I've been looking at. But regardless, it doesn't really matter, because here's the thing. When you're talking about these situations, whether it be politics, and I know everybody tells me it's never been like this before, it's a completely different scenario. We've seen a lot of scenarios, a lot of different things, and people do get upset and emotionally attached to what's going on with the investments. Here's the thing. What you have to remember is a couple of things. One, what's your time horizon, which is how long do you plan to have this money? Most of us are not planning to retire and spend all our money on day one of retirement, right? We're planning to be in retirement for 25 or 30 years, we hope.
Yes.
right? And so if we're doing that, if we have this time frame, we're going to go through several market cycles. So people come in, they'll be tell me, I'm 55 years old, I'm retiring at 60, I don't have time. No, you're not spending it all on day one. You still have a long time horizon. You still have several market cycles to go through, okay? So I'm not telling you for your individual situation what you should or shouldn't do, but these are things to consider. Another thing to look at is what is the purpose of the money? So I've had several of my clients who are maybe in their 70s, late 70s, that kind of thing, come in and be like, I really just feel like I need to be conservative. And then we look at, well, you have your pensions, you have your Social Security, you have your required minimum distribution, you're living well, you're not touching this money. Are you going to need this money? And they're like, no, this money's for the kids. Well, the kids are mid-40s, right? The kids have a longer time horizon. So if we're investing for the kids, that's a totally different discussion than if we're investing for you to have the needs in the next couple of years where you're going to need that money accessible. So it's a completely different conversation. Third thing to remember is what you're invested in. If you have a well-diversified, well-allocated portfolio, you're not in the S&P 500. Or the Dow Jones Industrial Average. What you're watching on TV is one segment of the market, but most portfolios, if you've got it well diversified and well allocated, they have bond funds in it. They have international funds in it. They have small cap and small company funds in it. You've got all these different asset classes that act different ways and cycle differently based on what's going on in the world. So your portfolio is probably not doing exactly what you're seeing when you sit there and watch MSNBC or whatever you're watching with it going up and down like that. So bottom line is your situation is unique, and what you should do is an individual decision, and that's one that you want to work out with your advisors.
And I think that's important. She hit on, we were having this conversation a lot lately, even leading up to the election. The key, all those things are absolutely valid, and when people listen to it and hear, they're like, oh, I didn't think about that way. Okay, because again, it's the same way with college. If you have a child go to college, did anybody write a check on the first day for all 4 years? No. Same way with retirement. But what people forget with retirement, if you retire at 65 and let's say you live to 95, you got 30 years of inflation to fight. So just moving it right to conservative money market.
Pop my bubble.
Well, I mean, you get what I'm saying, because
I understand totally.
If I'm living on 50,000 now, 50,000 doesn't buy the same goods and services. We're going to have to draw more, at 20 years from now. So that's the key. So.
Well, I guess one of the major things is anybody has any questions about this, what they need to do is make an appointment with you and come talk to you.
That's what we do.
Absolutely.
That's what you do. All right.
Yeah.
Thank you so much. We've got Jennifer and Carrie Milligan from Strojny & Strojny on our Expert Alert, and they'll be back again in a few weeks to answer some more questions here on WLOX's Expert Alert. Have a wonderful day.
If you have a question for any of our experts, go to WLOX.com and click on Expert Alert. For a list of any of our upcoming experts, go to WLOX.com and click on Expert Alert.